On August 5th, 2024, the Japanese stock market crashed 12% in a single day, worst drop since 1987. The S&P 500 fell 3%. The Nasdaq tanked. The VIX spiked to levels not seen since COVID. And here's the thing, there was no war, no recession, no company collapse. A trade you have probably never even heard of started to unwind, and the entire global financial system buckled. It's called the carry trade, and according to some estimates, it's a $20 trillion position sitting underneath literally everything we own. Your tech stocks, your bonds, your real estate, all of it partially funded by borrowed Japanese yen. And if you don't understand this, then you don't really understand what's actually holding up asset prices in the West. And you definitely don't understand what could potentially take them down. I'm Ari Van Gemeren. This is the Timeless Investor Show. Let's get into one of the most important mega trends of the last 20 years. On Monday, this past Monday, we covered the Japanese real estate bubble, the most spectacular property mania in modern history. The Imperial Palace, worth more than the state of California, in theory. 35 years later, Tokyo commercial real estate is still 70% below its peak. But here's the thread that I left hanging for you guys. Japan didn't just have a bubble. Japan became something completely different after the bubble, something that reshaped global capital flows for the next 3 decades. When the bubble burst in 1991, the Bank of Japan did what central banks do. They cut rates, and they kept cutting, and they kept cutting. By the mid-1990s, Japanese rates were very much zero. And by 2016, they went negative. For 8 years, Japan was literally charging you to save your money. And in doing so, Japan became the world's cheapest source of capital, a nearly bottomless well of money that could be borrowed for almost nothing. And this created something called the carry trade, and it has quietly shaped global financial markets for 3+ decades. Let me walk you through exactly how this works. I like to see things concretely, like let's just get into it step by step, because when you understand the mechanics of how a thing works, you understand why it matters a lot. Step 1, you borrow Japanese yen. So you go to a Japanese bank, you take out a loan at 0.1% interest. Let's say you borrow 14 million yen. That's about $100,000 at recent exchange rates. Step 2, you sell those yen. And by sell, I mean you convert them to US dollars. This is important. When you sell yen, you're putting downward pressure on the yen. You're making it weaker. Step 3, you take those dollars and you invest them. Maybe you buy, I don't know, US Treasury bonds yielding 5%. Maybe you buy tech stocks. Maybe you buy emerging market bonds that are paying even more. Doesn't matter. Step 4, you collect the yield. Now you're earning 5% on your investment while you're paying 0.1% interest on your loan. That's a 4.9% spread. Step 5, at some point, you unwind. You get rid of this thing. You sell your treasury bonds, you convert your dollars back to yen, and you repay your loan. And if the exchange rate between the two currencies remains flat, you just made 4.9% on a trade that cost you almost nothing to actually execute. But critical point, the thing that makes it dangerous is that exchange rates don't usually stay flat. And this is critical and really important to understand. When millions of investors do this trade simultaneously, all that yen selling pushes the yen weaker. It makes it weaker, right? More sellers trying to get rid of a currency, so the price of the currency drops, supply and demand. A weaker yen means when you convert back, you need fewer dollars to repay your loan. So you made money on the interest rate spread and on top of it, on the currency move, which the market helped to bring about. The trade reinforces itself. The more people do it, the more profitable it becomes. But this is the dirty secret. That 4.9 spread isn't actually that exciting. It's not hedge fund level returns. So what do traders do? They lever it up. They always lever it up. I mean, why wouldn't you, right? 10-1 leverage, 21, sometimes higher. Now that 5% spread becomes a 50% return or a 100% return. Now we're talking. Those are some big numbers. The carry trade isn't just about interest rate differentials. It's about leveraged interest rate differentials. And that literally changes the entire equation. Because when you're leveraged 20-1 and the yen moves 5% against you, you haven't lost 5%, you've lost 100%. You're wiped out. Margin call, forced liquidation, sell everything. And this is why the carry trade is often described as picking up nickels in front of a steamroller. The nickels are small. The leverage makes them worth picking up because it's really good. And when the steamroller comes, there's no time to get out of the way. It's very comparable to what happened to LTCM, long-term capital management, when genius never failed. But for 3 decades, with the Japanese yen carry trade, that steamroller just didn't come. The yen stayed weak or it got weaker, and Japanese rates stayed low. And the carry trade became one of the most profitable strategies in finance. Hedge funds use it, pension funds use it, Japanese insurance companies and retail investors, the famous Mrs. Watanabe traders, used it, and it scaled massively. So where does it go? What does it do? Because when all these trillions flow out of Japan, they don't just disappear into the ether. They go somewhere. And where they go, they change prices necessarily. Let me give you a concrete example. U.S. Treasury yields are lower than they would otherwise be. Japanese investors are the largest foreign holders of U.S. Treasuries, over $1.1 trillion. When you have a $1 trillion buyer showing up consistently, that is strong demand, guys. And demand pushes prices up. Higher bond prices means lower yield. One academic study found that Japanese net purchases of U.S. Treasuries reduced 10-year yields by 4 to 6 basis points within a month or two. Now, that doesn't sound like much, but across the entire Treasury market, across decades, that is meaningful, powerful. Your mortgage rate is literally lower because of Japanese capital flows. Corporate borrowing costs are lower. The entire cost of capital in America has been suppressed in part by cheap Japanese money looking for yield. Now, I want to clarify one point here. That number I just cited is not the effect of the carry trade. That is just the effect of Japanese institutional pension funds, the BOJ, and Japanese retail investors buying U.S. Treasuries. However, I just described the mechanism of this. If you're moving large amounts of money or you're leveraged to large amounts of money on the carry trade and you're buying the U.S. Treasury as your yield source on the end of the carry trade, that is a big impact. And that is not even discovered because nobody really knows how big the carry trade is. We don't know, but it's huge. It's massive. It has to be. Effect 2, U.S. stock prices are higher than they would otherwise be. When Japanese pension funds and insurance companies buy U.S. tech stocks, and there's buying pressure. A Mizuho analysis noted that the Bank of Japan's yield suppression since 2013 literally chased Japanese investors out of the domestic bond market. They had to go somewhere. They went to U.S. equities, especially momentum stocks. One analyst cited correlation studies showing a 0.55% relationship between yen carry trade unwinding and the S&P 500 drops. That is not a small number, guys. More than half the variation in the S&P 500 during unwind episodes can be linked to yen movements. Effect 3, emerging markets get flooded with capital. The carry trade does not just flow to the United States, although a lot of it does. It flows to anywhere with higher yields. Mexican bonds, Brazilian real, Turkish lira, South African rand. When Japanese money is looking for yield, emerging markets get a flood of capital that pushes up their currencies and asset prices. So when the carry trade unwinds, that capital leaves fast. Emerging market currencies can drop 1 to 3% within 30 days of a carry trade reversal. For companies that borrowed in dollars and depend on foreign capital, this can be destabilizing. And effect 4, real estate prices globally have been inflated. Where do you think some of that cheap yen went? Into property in the US, in Australia, in Southeast Asia, in Europe. The carry trade has been a background force supporting real estate valuations for decades. The point is this: the carry trade is not like just a currency trade. It is like a global liquidity pump. Cheap Japanese capital has been flowing into every asset class: stocks, bonds, real estate, commodities, even crypto, for 30 years. It's been a tailwind you didn't likely even know was there, supporting everything we have right now in this economy. And when that tailwind reverses, it can and will become a serious headwind, a very strong one. So how much money are we actually talking about here? And this is where it gets tricky because nobody actually knows how big the carry trade is, and that's part of why it's so dangerous. The Bank for International Settlements, basically the central bank of central banks, estimates the narrow definition at around $250 to $500 billion in direct yen-denominated loans to non-bank borrowers outside Japan. And that's just the tip. Goldman Sachs and other analysts point to Japanese investors holding over $3.3 trillion in foreign investments. Japan is the world's largest creditor nation. Crazy. Bigger than China. It's not a typo. Japan has more money invested abroad than any other nation on earth. Japanese institutions are the biggest foreign holders of U.S. Treasury at over $1.1 trillion, the second largest, right behind only the Federal Reserve itself in terms of impact on the Treasury market. According to Apollo, total foreign holdings of U.S. Treasuries are about $7.2 trillion. Foreign holdings of U.S. equities are close to $18.5 trillion. A significant chunk of that is Japanese money. Deutsche Bank has estimated that if you include Japan's entire government balance sheet, liabilities used to fund investments abroad, domestic assets that benefit from low rates, you get to something like $20 trillion. That is 500% of Japanese GDP. Now, is all of that the carry trade? No, but a significant portion of global capital allocation is built on the assumption that Japanese rates stay low and the yen stays weak. But when those assumptions change, capital flows will reverse, and that is when things will break. So I want to dig into this because I think it's fascinating. And, I remember my economics textbooks studying for the CFA. In theory, the carry trade should not work. There was a concept in economics called uncovered interest rate parity. It says that differences in interest rates between two countries should be offset by changes in the exchange rate. In plain English, if Japan has 0% rates and the US has a 5% rate, the dollar should depreciate against the yen by 5% over time. That would wipe out your carry trade profits, arbitrage away. That's the theory. In practice, the opposite happens. Currencies with high interest rates tend to appreciate, not depreciate. The yen gets weaker, not stronger. This has been documented in academic literature for 40 years. It's called, there's even a name for it, the forward premium puzzle. Eugene Fama, the efficient markets guy, Nobel laureate, excellent guy overall, documented this back in 1984. Researchers have been trying to explain it ever since. Some theories, risk premiums. Certain currencies carry more crash risk as investors demand compensation. The carry trade works until it doesn't, and when it fails catastrophically. Other theories that have been bandied about, behavioral factors, herding. Once everyone piles into the same trade, the selling pressure on yen makes the trade work. It's almost self-fulfilling. One paper I found particularly compelling, Brunermeyer, Nagel, and Peterson in 2008, showed that carry trades are essentially short volatility bets. They generate small, consistent profits when markets are calm, and they blow up when volatility spikes. They are picking up nickels, as I said, in front of a steamroller. And when the steamroller comes, it's coming fast. So let me tell you what happened in August 24, because it's a preview of what might happen on a larger scale. Going into summer 2024, the carry trade was enormous. Hedge funds had the largest short yen positions in 17 years. The yen had weakened to 161 per dollar, its lowest in nearly 4 decades. And then two things happened in very quick succession. On July 31st, the BOJ surprised markets by raising rates to 0.25%. It doesn't sound like much, but it doesn't matter. The raw level is not important. It was the first rate hike in 17 years, and they signaled that more were coming. And then, right around the corner, on August 2nd, the U.S. released a very disappointing jobs report. Only 114,000 jobs added. Suddenly, the market started pricing in Fed rate cuts. The math changed instantly. The rate differential, the whole reason the carry trade works, started narrowing. Narrowing, right? All of a sudden, the cost of borrowing in the yen is rising, and the cost of getting money in the US dollar is dropping. So your spread is narrowing, right? The math isn't there anymore. And in a matter of days, the yen started rising and appreciated over 10% against the dollar. Now, that doesn't sound catastrophic until you remember the conversation we had earlier about leverage, okay? If you're running a carry trade at 20-1, leverage in the yen moves 10% against you, you have not lost 10%. You have lost 200% of your equity. You're not just wiped out. You actually owe your lender money above and beyond what you borrowed. So what happens? Margin calls, forced liquidation, traders unwind. They sell their U.S. stocks, their treasury bonds, their emerging market positions. They buy yen to repay their loans. That buying pressure pushes the yen higher. which forces more unwinds, which pushes the yen ever higher. It is a vicious cycle, a feedback loop of apocalyptic proportions. On August 5th, the Nikkei crashed 12.4%, biggest single day drop in history, bigger than Black Monday in 1987 in percentage terms for Japan. The VIX, Wall Street's fear gauge, spiked above 60. That's territory you only see in crises, COVID, 2008. The S&P fell 3%. The NASDAQ got hammered. Bitcoin dropped 15%. Emerging market currencies collapsed. And here's what's interesting, though. U.S. Treasury yields actually fell during this episode, the opposite of what you might expect if Japanese investors were selling treasuries. So what happened? Instead of selling their bonds outright, many Japanese investors put on currency hedges. They were protecting against further yen appreciation rather than liquidating. The safe haven bid for treasuries from panicked equity investors overwhelmed the selling pressure. But don't let it comfort you that much. The March 2020 unwind was different. Treasury yields initially spiked as foreign sellers scrambled to raise dollars. The mechanism can go either way, depending on the specific mechanic and dynamics of what's happening. And if Japanese investors actually start repatriating capital rather than just hedging, the math will change fast. And then by the end of the week, calm was restored. The BOJ walked back its hawkish comments. The Fed signaled support. Markets recovered. But here's the thing. According to UBS, roughly $200 billion in carry trades unwound in those few weeks. And that may have been only half the total exposure. JP Morgan estimated the speculative positioning was about halfway unwound as of mid-August, which means half of it was still out there. So here's the bear case. Why could this be a much bigger deal going forward? Japan is in the process of normalizing rates for the first time in decades. They raised to 0.5% by January 2025, the highest in 17 years, and they're expected to keep going. Meanwhile, U.S. rates are likely to come down as the Fed eventually cuts. The spread is narrowing from both sides. Japanese government bond yields are spiking. The 40-year JGB hit a record 3.7% recently. The 10-year is at levels not seen since 2008. This changes the math for Japanese investors. Why take currency risk to own U.S. treasuries of 4.5% when you can get nearly 3% at home with no currency risk? Japanese institutional investors, pension funds, insurance companies hold over $1 trillion in U.S. treasuries. If they start repatriating that capital, that is selling pressure on U.S. bonds. That pushes U.S. yields higher. That affects mortgages, corporate borrowing, everything. And it's not just bonds. Remember, Japanese investors have been big buyers of U.S. tech stocks. If they unwind those positions, that's selling pressure on the Mag 7. The Societe Generale strategist Albert Edwards calls this potential scenario global financial market Armageddon. His words, not mine. The carry trade has been described as financial dark matter. It's everywhere, it affects everything, but it is invisible until it moves. Okay, but here's the bull case, right? Because this might not be that catastrophic, and I don't want to be a doomsayer over here all the time. So first, the August 2024 event was sharp but short-lived. Markets recovered within days. The BOJ backed off. The system held. Second, the most speculative short-term positions have already unwound. The futures market, where leverage is highest and margin calls are most aggressive, has largely cleared out. What's left is longer-term institutional money that moves much more slowly. Third, the BOJ is aware of the risks. After August, they explicitly said they wouldn't raise rates if it caused market instability. They are trying to normalize, but they're doing it carefully. Side note, whenever central banks say this, I find it to be highly suspicious because they're acting like they can actually control what's going on, but it's all about investor sentiment and narrative. The BOJ says they're not going to raise rates to cause market instability, but what happens if investors start demanding higher rates, right? They can't. The BOJ cannot control longer-term bond rates in their market. They cannot, right? It's a ultimate farce of humanity to think we can control something as wild, savage, and chaotic as the global markets. We cannot. We cannot. It has its own life, its own zeitgeist. Fourthly, Japanese investors have real reasons to stay invested abroad. Japan's economy is small and slow growing. The U.S. offers better opportunities. Even with some yen strengthening, the diversification benefits remain. Fifth, the rate differential is still positive. Even at 0.5% in Japan versus 4.5% in the U.S., you are still getting paid to do the trade. It's less attractive than it was, but it's not negative. And 6, orderly unwinds are possible. If this happens gradually, markets can absorb it. The problem is rapid, forced unwinds driven by margin calls and panic. Slow and steady is manageable, and that seems to be in the direction we're heading now. So, what can you actually do with this information? First, understand that asset prices everywhere have been partially supported by cheap Japanese capital. That's not a reason to sell everything, but it is a reason to be aware of what's underneath. Second, monitor the yen. If you see the yen strengthening rapidly, especially breaking below 140 per dollar, pay attention. That's a sign of carry trade stress, and it often precedes volatility in risk assets. Third, pay attention to BOJ policy, their meetings, their statements, their rate decisions. This used to be a backwater. Nobody cared what the BOJ did. That has changed. Japan is now at the center of global macro. Fourth, think about your leverage. If you're using floating rate debt, if you're levered to real estate or other assets, understand that liquidity can dry up very quickly if and when the carry trade fully unwinds. Fixed rate debt, cash reserves, conservative structures, these matter more than ever. Fifth, don't panic. The August episode was violent but contained. That doesn't mean the next one will be contained, but it also doesn't mean the system is about to collapse. The right response is awareness, not fear. Understand the forces at play. Grasp what's happening. Understand the global macro. It's super important. And position yourself conservatively and be prepared to act when others are panicking. So let me close this episode with you guys with 5 lessons from the carry trade. 1, the most important forces in markets are often invisible. Most investors have never even heard of the carry trade, or maybe you saw it on Squawk Box one time, I don't know, but it's been shaping asset prices for 3 decades. And the biggest risks are often the ones that you do not see coming. Everything that market pundits talk about and they tell you is a big risk, the whole tribe can see it. It's no longer a risk. The thing that kills bull markets is a wallop coming from outside the campfire in a direction that none of us were looking at, right? That's what you have to be careful of. Lesson 2, what works for a long time can fail very quickly. The carry trade was profitable for 30 years. It was greatly profitable to be a Lloyd's names, as some of you that watched our Lloyd's episode before saw. For a very long time, it was profitable, but it doesn't always work, right? It didn't work for the names. It's probably not going to work for the carry trade forever. 3, leverage amplifies everything. The carry trade is inherently a leveraged bet. When it works, it compounds returns, but when it fails, it crushes you. Leverage is the killer. 4, central banks are not all powerful. The BOJ kept rates negative for 8 years. They distorted global capital flows. They're now trying to normalize. And they're finding that exiting this world they've created is much harder than entering. Policy has consequences that unfold over decades. We don't even know where this is going to take us. And 5, really interesting insight for you guys. Global markets are connected in ways we do not fully understand. A rate hike in Tokyo, a jobs report in Washington, and suddenly stocks are crashing from New York to Sydney. The interconnections are real, they're growing, and they will surprise you at some point. So the yen carry trade is one of the most important global forces in finance that almost nobody has talked about. For 3 decades, it has pumped cheap Japanese capital into every single asset class that we're investors in. It's not ending, but it is changing. Japan is normalizing, the math is shifting, and the August 2024 episode was a warning shot. I don't know exactly when or how this plays out. Nobody does. But I know that understanding these forces, seeing the invisible machinery behind asset prices, does give you an edge. The people who got hurt in August were the ones who didn't see it coming and used too much leverage, almost for sure. Don't be one of them. Own real assets, conservative leverage numbers, understand the flows, think in decades. If you got value out of this episode, subscribe, hit the notification bell, leave a comment, let me know what you thought, hit that like button. It really helps the show to grow, our channel to grow and reach more people. And I just really appreciate you guys being here. Think well, act wisely, build something timeless.